Welcome everyone to Vested Interest. This is Shane, back again for another video of the 4 stocks I'm looking to buy in February and 2 ETFs we are going to continue to buy throughout 2024. Yes, it is that time. Again, we have almost wrapped up another month in the new year. January is almost over, on to 2024. And before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, well, on this channel we focus on dividend growth investing, buying stocks in good companies with growing dividends and hold them for the long term. Well, it's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing dollar cost averaging in dividend growth stocks and growing companies with positive cash flow that covers the dividend with a high return on their invested capital. I cover all of my investments into my portfolio every Sunday morning. So if you're interested in that type of content, go ahead and hit that subscribe button down below. I do not have a paid Patreon account, paid paywall, anything to access. We all have enough to pay for, so it's free to see what I'm doing in my portfolio every week. I'm not trying to sell you a course like some other YouTubers out there, or sell you anything at all. But if you'd like to help the channel, hitting that subscribe button, hitting that notification bell, dropping a comment down below, and most importantly, subscribing to the channel really does help a small YouTube channel like mine. And watch to the end as well. Watch time does factor into the YouTube algorithms. So all those things really help. And again, we are going to look at 4 stocks that I may be looking to buy in February. Some of them I have already started to buy and will continue to. Alibaba is in my portfolio. CVS is in my portfolio. But then we are going to take a look at 2 new positions that I may be adding over the next month, if the price is right, whenever I'm looking to add them: American Electric Power and Black Hills Corporation. Let's jump into the video. And again, if you are new to the channel or would just like to help me out, hitting that thumbs up, hitting that subscribe button down below, and ringing that notification bell, as well as dropping a comment and let me know what you think of the video and what you are buying for this month. That really helps out a small YouTube channel like mine, helps get the word out. Dividend growth investing, that's what we focus here on this channel. So join us on this journey to financial freedom. Join the Vested Interest community, and hopefully you're on your own journey as well and have already started building wealth. So let's keep going here. So this is the Vested Interest Stock Screener. This is how I set up my stock pick of the day videos Monday through Thursday. That's another series that I do along with a series like this every month, where I show you what I'm looking to buy for the next month coming up. I do a stock portfolio reveal every Sunday morning, and then I also will cover all the dividends that I've been paid out for the month, any options, anything like that, in a video. So that'll come out as well probably next Friday. We'll cover everything from the previous month, which will be January, as we enter into February. So I like to look at a business, understand the business. We want growing free cash flow over the last 5 years, expected into the future, growing dividend payout ratio of 75% or less. So this does not apply to REITs or BDCs. Check valuation based on dividend yield theory. Buy below current cost basis or within 15% of 52-week low. If it's in my portfolio, I'm trying to buy it under my cost basis. If it's not in my portfolio, I'll do a discounted cash flow analysis on the company, see what I'm willing to pay, and then try to marry that price whenever it drops to within 15% of its 52-week low. I also look at return on invested capital or return on equity. I like 10% or better, or greater than its industry average or in line with its industry average, and earnings per share growth greater than its industry or in line with its industry, or 5% plus. I really focus on the 10% plus and the 5% plus for those two. For banks, I also throw in price to book, 1 being fair value, anything under 1 being undervalued, anything over 1 being overvalued. Price to book you can use for any company. Just make sure if it's not a company like a financial company, like a bank, you're comparing price to book of that company to other companies in the same sector. And it must meet 5 of 8 for me for it to be investable. It usually goes on my watch list first, then I do more of a deep dive into the financials, or 6 of 9 if it's a financial company. Now, don't just blindly copy my stock screener. You can utilize this as another back check if you have your own, or add to this, take away. These are just the ones that have set up for me. I'm in my mid 40s. I'm looking for more on the income side. Some of you younger folks might want to look for something more on the growth side. So we all have different timelines for retirement. We all have different investing criteria. We're all in different points in our investing journey. So again, don't just blindly copy me or anyone else, and don't just buy something because you see it on YouTube. I am not a professional. I do not have a degree in finance or work for a hedge fund or any kind of company that invests in stocks. I'm not a financial advisor. I'm not a financial guru. I'm just an average guy who goes to work every day, has 2 kids, and realized that the only way to get out of the rat race, the only way to get out of working 9 to 5 every day is to eventually replace my income, and I am utilizing my dividend growth portfolio to eventually get me there. That's the idea behind this type of investing. So let's jump right into stock number 1, Black Hills Corporation, ticker BKH. This would be a new position if we chose to jump into it this month. It is one out of the utility sector that I am looking at. They closed the day out on Friday, the last day of the trading week, at $50.80. They were down slightly. Their 52-week range is, and if I didn't mention, this is out of the utility sector. Their 52-week range as low as $46.43, as high as $73.98. They are closer to their 52-week low than their 52-week high, though they still have some room to go. Now, you can see down here, they estimate, where I pulled this chart from was Yahoo Finance. They estimate that it is still slightly overvalued. So if you were to buy it now, you would get a -7 estimated return, right? So it's near fair value, but not quite there yet. But if you look over here, now this is more for traders. You know, I don't, neutral pattern detected, commodity channel index. I don't know I'm not a trader. So for any of those of you who may be traders out there, you know, maybe explain that down in the comment section, or for those of you who are interested, you can look it up. I'm not a trader. I don't use this. But I do like their outlook, because if you look at this, part of the reason it's on my list for next month is I am hoping that this outlook holds true, that it continues to come back down towards this 52-week low, if not set a new 52-week low. So this is telling me they estimate in the short term, the next 2 weeks to 6 weeks, it's going to come down. Next 6 weeks to 9 months down, and 9 months plus it's going to come down. So it's, or it might be right now, I'd have to do the math, within 15% of its 52-week low. So I'm willing to start a position in it when it hits 15% of its 52-week low, even if it continues to go down, because I'm going to build out that position, and I don't mind buying myself down, decreasing my cost value and increasing the dividend return here. Now, the market cap is $3.45 billion, beta of 0.66, so it is less volatile than the overall market, even though it looks like there's been a lot of volatility over here the last trading day. This is typically less volatile than the overall market. Price to earnings, PE ratio, sitting at $13.19 per share. EPS, earnings per share, sitting at $3.85. Earnings date is coming out February 5th through February 9th, so the first part of next month, and that may impact it as well, right? If there's bad earnings, this might drop and set a new 52-week low. So again, I'm willing to jump into it within 15% of its 52-week low, start a position, and then continue to build out this position over the next at least month, if not longer. Forward dividend is $2.50 with a very nice starting dividend yield at 4.9%. Ex-dividend date was November 16th. They paid out on December 1st, so they should have one November, January, February. March would be their next one, right? Or their next ex-dividend date, I believe. And I think they may pay out on March. They may pay out on April. I'd have to look that up. If you know, drop a comment down below. What month does BKH pay out, Black Hills Corporation pay out? And according to Yahoo Finance, they have a one-year target estimate of $58.83. So they see some upside in the price appreciation on this one potentially. Now we're going to look at dividend yield theory. We want to see if this one is potentially undervalued. To do that, you'd actually click on statistics. You'd go down to dividends and splits. You compare it 5-year dividend yield average, 3.41, to its current, 4.90, or over here where it says forward annual dividend yield, 4.90. And since it is higher, and it is quite a bit higher, this one actually has, according to dividend yield theory, quite a bit of a margin of safety right now. It speaks to some undervaluation. Again, at least according to dividend yield theory. You might want to do a discounted cash flow analysis or some other type of analysis to get an idea of what you might want to pay for this one. But right now, according to dividend yield theory, this one is undervalued with a nice margin of safety. Payout ratio is under the 75% or less that I like at 64.94%. Now, because this is a utility company, I actually don't mind a company like this going over the 75%, because typically utility companies are paying 80, 90% of their free cash flow out because they're a regulated utility and they don't mind going over that payout ratio of 75% that I use for other companies. Now, this one just happens to be under that 75% that I like. So this is nice. That's good for me. Now, I want to look at free cash flow real quick. We're going to go down here. We go back to 2020. We see negative, and you see this with a lot of utility companies. We'll see it with the other one as well. Negative free cash flow, negative 225,541,000. And I know that's 225,541, but with Yahoo Finance, you add 3 zeros to the free cash flow. So this is really 225, negative 225,541. Big drop in 2021. Must have had a write down here or something. Negative 742 million. And then it starts to come back up and look good again. 2022, negative. It's still negative, but only negative 19 million. And then finally in 2023, we're actually in the positive 280, which is not common for utility companies. So we're actually seeing some green here, 286 million. Though what is a little concerning to me is they stopped paying down their debt for some reason in 2022 and 2023. I would like them to continue to repurchase their own debt. Let's jump over to return on equity and return on invested capital. This tells you how efficiently a company is reinvesting back into itself. And try to remember these numbers. Return on equity, I like 10% or better. This is sitting at 8.2. This is actually very good for utility company. Return on invested capital, same thing. I usually like 10% or better, but 5.24. I usually like 10% or better, but this is good for a utility company. We'll compare this to the other utility company we're looking at for next month, and you will see why I say it's good for a utility company. So I don't mind these numbers, even though they don't hit the 10% I'm looking for. Their margins look good. Other numbers that I look at deeper look good on this one. That's why it's on my list. You should be looking deeper on this one. Look at the revenue growth. Is it growing? Look at their assets over liabilities. Does that look good? Are their margins good and growing? Are they paying down debt? Last couple of years they have actually not been, which I don't like. I hope they restart that again. But let's keep going here to the last one. I like 5% or growth, 5% or better earnings per share growth, EPS. They're only at 3.26. Same thing, not necessarily bad for a utility company. They're growing over 3%. I do like that. And their revenue growth is projected to grow 3.05%. Overall, I really like the numbers on this one. This is number one, Black Hills Corporation, ticker BKH. And this one is a maybe. I do want it to come down a little bit more. I'm hoping that it does. That's what it's telling me right here. So if it drops under 50, I will probably add this to the portfolio over the next month. On to number two. This is the most recent addition besides the two ETFs that I've added to my portfolio. We are talking about Alibaba Group Holding Limited, ticker BABA. Now, this is a Chinese company. Some of you might not want to invest in China. That's fine. You take it off your list if you don't like it, but it is one that I'm going to continue to add to. Currently, I have 34 shares. I just started this position recently. I'm already up 2.69%, which I actually don't like. I'm hoping that they pull back a little bit, back towards under the $72. I would love to buy them back in the 60s. I got 10 shares last week at $68, $69 per share, and this week it's really jumped up, right? The founder and the current CEO bought a bunch of shares, so people took that as a good sign, and now it's run back up. But I want it to stay under $80 per share while I build this one out. I want to get it to at least 100 shares, currently at 34. We've been adding 10 shares a week for the last couple weeks, so I'm going to continue to do that this month as long as it stays under $80 per share. So 52-week range as low as $66.63, as high as $119.71. Again, last week we bought some at 68. I'd love it to drop back under 70, at least stay in the mid to low, under 70, at least stay in the mid 70s or low 70s here over the next month so I can build this one out. Down here, you can see they estimate the return at 10%. So they see this one as undervalued. The last one we saw, they saw it pretty close to fair valued or even a little overvalued. This one, they estimate, at least according to Yahoo Finance, that this is potentially 10% undervalued. Market cap of $188.049 billion. A beta of 0.55. So this one is less volatile than the overall market. You can see that run up here. Over the day, right? Went from opening of $73, closed out at 74, so jumped $1 on the day almost. PE ratio, price to earnings, sitting at $10.37. Earnings per share, EPS, sitting at $7.14 per share. Earnings date was or is February 7th, coming up next month, first part of next month. Forward dividend is $1. They only pay out one time a year. Low starting dividend yield, 1.35%. Don't know what it's going to look like because they just started paying out a dividend. So hopefully this has growth over time. I'm taking a gamble on this one a bit because they just this January was their first dividend payout. Ex-dividend date was December 20th. They paid out on January 18th, right? So if you bought them now, you wouldn't get the next dividend until next January, unless they change their payout schedule. And according to Yahoo Finance, 1-year estimate of $115.30. So they see some significant potential significant upside for this one here, from 74 all the way up to $115.30. They actually say bearish here, but then if you look at their short term, they see it continuing to go up, midterm continuing to go up, and then in the long term, maybe coming back down to the 66. So again, I'm going to buy this one in the 70s. So long as it stays under 80, and my cost basis it stays under 80, I'm going to run this up to 100 shares, or try to run this up to 100 shares. I hope this is right, bearish, and this short term and midterm are wrong. But so far this week, they've gone from $68 last week up to 74 where they're at currently. All right, now we're going to get into statistics again, look at dividend yield theory. To do that again, 5-year dividend yield average. They don't have one because they have not paid out for 5 years. So we don't have anything to compare this one to, right? So I'm just looking at it as undervalued currently, taking this with a grain of salt and saying that I'm willing to buy it under $80 per share. That's where I'm at with this one. They do have a very low payout ratio, 13.9%. We're going to look at free cash flow here. As you can see, 2020, $135 billion, 2021, $188 billion, a bit of a drop down here, $89 billion in 2022. So far in 2023, $165 billion. Looks like they might report out at $178 for the total of the year. They are repurchasing their own shares. And so overall from 2020 to date, there definitely is free cash flow, and very nice free cash flow beyond this one blip in 2022. Though you can see some of that drop can be accounted for the repurchase. They really started getting aggressive on their repurchase of their own shares. So definitely growing free cash flow in this one. I have 34 shares. I am up 2.69%. Would like to get that to 100 shares with the cost basis under 80 per share. We'll see how that goes. Return on invested capital, again, I like 10% or better. Return on equity, 10% or better, sitting at 13.2%. That beats the 10% I'm looking for. And now return on invested capital sitting at 9.17%, slightly under the 10% I'm looking for, but not egregiously so. I can take that. EPS growth, smoking high. I like 5% or better, and this is sitting at 22.92%. That is extremely high earnings per share growth. Revenue growth forecasted at 7.72%. Again, very nice revenue growth expected on this one. Really like this one. Again, really would love to build this out to over 100 shares under $80 per share. Let's keep going. That's number 2. Number 3, CVS Pharmacy. Boy, I built this one out here a couple months back, and then it ran up, and now it is pulled back again. So I'm going to nibble on this one at least and add some more to this position. We are talking about CVS Health Corporation, ticker CVS. This is out of the healthcare sector. BABA, if I didn't mention it, was out of the consumer discretionary sector. But let's jump down here. They closed out the day at $73 on Friday. 52-week range as low as $64.41. Another one I don't mind if it pulls back. I'd love it to get it down here under the 70s again, back in the 60s. Would love to build this one out a little bit more, as high as $90.62. They estimate this one to be extremely, extremely undervalued, 71%. Now, I don't know if I buy that it's 71% undervalued, but they do say that they estimate it to be well under its current value right now. Now we're going to look over here again. I don't know what gap down means, but if any of you know what gap down means, if some of you are traders out there, let me know down in the comment section below. They see in the short term, midterm going down, and then 9 months out, they see it going back up. I'm hoping for these two to happen so I can build this one out a little bit more. Market cap of $93.94 billion, a beta of 0.48. Price, so it is less volatile than the overall market, quite a bit. So price to earnings ratio, PE ratio, very low at 11.18. Per share. Earnings per share, very nice, $6.53 per share. Earnings date is coming up February 7th, so we got a lot of earnings dates coming up here in February. Forward dividend is $2.66, a nice 3.69% dividend yield. Very low payout ratio, 36.22%. 1-year target estimate of $89.74. So they see it over the next year climbing back up to $89, not quite back to its 52-week high, but pretty close. Now let's look at dividend yield theory. Again, to do that, you'd click on statistics. You'd go down to dividends and splits. We look at the 5-year dividend yield average, 2.87%. Compare it to its current 3.69%. Same number, 3.69%. Forward dividend yield is the current dividend yield. And since it is higher than their 5-year average, that speaks to some undervaluation. And again, undervaluation with a nice margin of safety. Very low payout ratio on this one as well, 36.22%. January ex-dividend date, they're going to pay out on February 1st. So I'm looking forward to this payment coming up next week. We're going to look at free cash flow real quick. 2020, $13.4 million. 2021, $15.7 million. A bit of a drop in 2022 to $13.4 million. So far in 2023, $11.3. But again, if you look at the repurchase of capital stocks, even though it looks like there was a drop in 2021, they weren't repurchasing any shares that year. But then in 2022, they started aggressively, and again in 2023, repurchasing their own shares. So I can more than account for this drop in the repurchase of the capital shares. And overall from 2020, I'm calling it nice growing free cash flow over the last several years. Return on equity, again, I like 10% or better. This tells you how financially efficient a company is reinvesting back into itself. And that's why I use 10% or better. Return on equity sitting at 11.9%. That meets the metric there that I like. Return on invested capital a little lower than I'd like it at 6.74%. I typically like 10% or better, but this being a retail company, now it's not just retail. They also have their hand in a insurance company that they've recently bought, but a lot of that is not showing up in their numbers yet because it's a recent acquisition. So they have done a lot of things with CVS to turn this one around, and I am expecting them to really start seeing the benefits of those. And I think that's why they have them estimated at 71% undervalued, because I believe they are estimating that they're going to start seeing some of that increased revenue from the insurance side, as well as the pharmaceutical companies, and as well as some of the walk-in health centers that they're putting in their facilities. So this company has done a lot of things over the last 4 or 5 years that I think over the next 4 or 5 years they're really going to benefit from. Now we're going to look at EPS growth. Again, I like 5% or better. This is smoking high, 24.54%. If that holds true, that is very, very high earnings per share growth over the next 5 years. Revenue growth forecasted at 5.84%. Very good, especially for a retail company like CVS, though I think some of that, again, is going to be driven by their insurance arm that they've recently acquired. And again, one in my portfolio, this is one I would just continue to build out. I would probably take it to 150, 160 shares. I already have 10,000, or around 10,000 into the position. It's up a little bit, 3.73%. I would like it to pull back down under my cost basis. Like I said, $70.37 is my cost basis. I'd love it back in the 60s to build this one out a little bit further. And like I said, maybe take it to 160, even 170 shares. I wouldn't mind this being close to the same size as like a Johnson & Johnson. I really like this company right now. I think it's at a great price point. If you have not taken a look at this one, I would really recommend you take a look at CVS. And the last one, this is another utility company, American Electric Power, ticker AEP, American Electric Power Company. Closed out the day at $77.84, as low as $69.38, as high as $96.05. So it is closer to its 52-week low, but I would like it to, again, if you look here, right, bearish pattern, short-term, mid-term, long-term, they expect it to go down. If you noticed, all the ones we're looking at, except for BABA, I think, are expected to go down over the short-term and mid-term, so that's part of the reason they're on my list. I want to make an entry, and then I want to be able to bring my cost basis down and get this as low as possible over the next month or two. So I will probably not add both American Electric Power and BlackRock Hills, but I'm going to add probably one of them. I want another. The only company I have in the utility sector is NextEra Energy, and I would like at least one more company in that sector. So right now I'm looking at these two, American Electric Power and Black Hills Corporation. They're the BK8s that we saw before. So AEP is the ticker. They are out of the utility sector. $77.84 close out the day on Friday. Again, the 52-week low we just went over, $69.38 for the low, $96.05 for the high. Again, they see it potentially 11% overvalued. So this one is potentially overvalued. So I do want more of a pullback, right? I really love it under, I think around 72-ish or under is where I would be comfortable at this one. So I'm hoping that it pulls back. Market cap $40.934 billion, a beta of 0.50, so typically less volatile than the overall market. Price to earnings ratio, $17.85 per share. Earnings per share sitting at $4, not 14, $4.36 per share. Another earnings date coming up in February, but at the end of the month at this time, February 27th. For dividend is $3.52. Very nice dividend yield, 4.51%. Ex-dividend date, February 8th. They pay, well, they said the last payout, that's not right. It's not going to be December 8th. They're not going to go back in time and pay you. It's probably either going to be in February or March that they pay out here. Again, if anyone knows when this one pays out, let me know in the comments section down below. I think it is March. And 1 year target estimate, at least according to Yahoo Finance, $86.84. So they do see some upside in the appreciation in the stock price. Again, we're going to look at dividend yield theory, hit statistics, go down to the dividends and splits, look at their 5-year dividend yield average, 3.38%. Compare it to its current, 4.51. Over here, forward annual dividend yield, 4.51. And since it is higher than their 5-year average, that speaks to some overvaluation, or not over, I apologize, some undervaluation on this one. If this number was lower than their 5-year average, that would speak to overvaluation. So not only is it potentially undervalued because of dividend yield theory says it has a nice margin of safety. 4.51 difference to 3.38 is significant. That's a significant margin of safety for this one. Now, this payout ratio is over the 75% that I typically like at 76.15%. But again, I don't mind it because it's a utility company. They typically pay 70 plus, 80%, 90%. Dividend yields on these type of companies. It's just the way they are. They're a regulated utility company. They're not forced to pay out that, but they are slow growers typically. Their stock price does not grow a lot, so they're offering you a higher dividend yield. You'll typically have a higher dividend yield, slower growth, but they do that with a higher payout ratio, right? That's how they're trying to entice you. And they're really for people like me who are older or retired already, who are looking for pretty safe income, right? People aren't going to stop paying for their lights and utility bills. More than likely, they'd give up their car or something else before they let their heat go off or their lights go out, right? So that's why older people like me looking for income, looking for cash income from dividends, jump into a lot of utility companies because of the nature of their business. Now let's look at free cash flow, and you're going to see something. Remember, we talked about this with the Black Hills Corporation on the other one, BKH there, the other utility company we looked at. A lot of negative numbers in their free cash flow. This is no different. 2020, negative 2.4 billion in free cash flow. 2021, negative 1.9, so that's actually better than the year before. 2022, negative 1.4, that's better. Now this is where it gets a little dicey. I do not like that they really, really went in the negative here. Free cash flow, negative 3.5 billion in 2023 so far. They are repaying debt, but this right here is the only reason I'm leaning towards Black Hills. They're the first utility we looked at, and why this one is the last one, because this gets me a little scared. I'm not sure if there was a write-off this year. I need to do a little bit more research on this one. That's why it's on my potential watch list and not one I'm definitely going to be buying. But this is the only thing that gives me a little bit of reason to pause, right? Now, let's look at return on invested capital. If you remember, we were at 8% with the other utility company. This one's sitting at 9.30% for return on equity. So again, very much in line with the other utility companies out there. Return on invested capital, I think we saw 5 or 6% there for the other utility company. This is sitting at 5.08%. So they don't meet the 10% that I'm looking for, but they are in line with their industry average. Earnings per share, again, I like 5% or better. Very nice expected forecasted growth here at 8.58. Beats the 5% I'm looking for. And revenue growth expected at 3.69%. So good numbers overall. This little blip right here, if there's a write-off, I'm not as worried about it. Again, because it's a utility company, they are capital intensive. Typically, they are in the negative for free cash flow, just the nature of their business. But this is a big drop, so I want to look and do more research, and see what's going on with this one. Now to the 2 ETFs. So those were the 4 stocks we're looking at potentially buying next month. BABA will definitely be buying. CVS will probably add a little bit. It will be one or the other for the utility companies, but this we are buying every single week. SCHD, the Schwab U.S. Dividend Equity ETF. Here are the top 10 holdings: Verizon, Broadcom, Amgen, Coca-Cola, Pepsi, the Home Depot, AbbVie, Merck, Texas Instrument, and BlackRock. So I'm going to be adding at least one share of SCHD every week. This ETF is just our weekly. We've just started that to start out the year, so we're going to do it at least through this year. Right now we're sitting on 4 shares. We are up slightly at 0.9%, and we're just going to continue. Doesn't matter what the cost is. Every week we're going to add at least one share of SCHD. Join us or let me know in the comment section down below if you are doing that. What stocks do you buy every week, or what ETFs do you buy every week? Let me know in the comment section down below. So some of the things I like about this 52-week range isn't as important, but it does have a low of $66.67, a high of $78.16. It is right up against its 52-week high. Net assets $52.048 billion. Price to earnings ratio $14.61 per share. Yield 3.49%. Nice dividend yield on this one. Year-to-date return, not a lot, 0.35. So at 0.9%, I'm actually beating its year-to-date return, believe it or not. Beta of 0.79, less volatile than the overall market. Very low expense ratio, 0.06. That's the fee you pay for every $10,000 multiplied by 0.06. That'll tell you how much you're paying. That's very low, right? 0.06, 0.04, 0.03. That's where you should be. A lot of Schwab and Vanguard ETFs are low like that, so make sure you're not paying a lot in expense fees if you are buying index fund and ETFs. One share a week, every week. That's what we're doing. Join me on that if you haven't already. And you don't have to pick SCHD. Let's look at the other one. The other one that I like, VTI, Vanguard Total Stock Market Index Fund, ticker VTI. This is the entire New York Stock Exchange, the entire American market, sitting at $242.12. 52-week range as low as $190.18, $243.02 for the high, right up against 52-week high. Net assets $1.46 trillion, right? With a T, not a B, trillion, not billion, TT. PE ratio sitting at $22.77. So this is elevated, but that's just what the overall market is right now, right? I typically like to buy stocks around the 15 price to earnings ratio. This is the average market right now is higher than that at 22.77. That's just what it is. Yield at 1.44, so it doesn't have as high of a yield as SCHD did, but that's all right. Year to date, total return 1.59. Again, another one, right? I've got 4 shares. We've been adding 1 share every week so far for the year. I'm actually up 1.97, so I'm actually beating its year to date total returns. A beta of 1.01. So this is the market, basically. It says it's just slightly over the market. So it really is going to match the market because that's what it is. It is the market, the total stock market index fund, the total American market. Its expense ratio is a little lower than SCHD at 0.03, right? This is a Vanguard fund. You can find a lot of good Vanguard funds and Schwab funds that have very low expense ratios. That's what you should be looking for. 0.06, 0.04, 0.03, very low. But very different holdings, right? Top holdings, Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Alphabet Class A, Alphabet Class A, Alphabet Class C, Tesla, Berkshire Hathaway, United Health Group. You're buying everything in the United States stock market when you buy this, right? And I do have 4 shares, again, slightly up 1.97%. So let me know what ETFs you are buying in the comment section down below. What stocks are you looking to buy for the month of February? Would really like to hear from you. And these are some other ones I still see value in, and I might nibble on these throughout the month. Realty Income definitely will be adding some over the next month. Nutrien as well. Pfizer I may add a little bit to. Enbridge I'd like to add to. NextEra Energy, I might not add to this one. I think it just jumped up here this week. If it did, I probably won't. Owens Corning, I am still waiting for a bit of a pullback on this one. Johnson & Johnson, I'm seeing a lot of value there. I might nibble on that, though it's my largest position. So if I do, it'll just be a couple shares. And Genuine's Parts Company is one that I would like to add to the portfolio. I do not have any shares, but it is one I'm seriously considering adding at some point this year as well. So there's others out there, guys. If you know of other stocks out there that you're seeing value in, drop them in the comment section below as well. Share with what you are seeing value in the market out there. But Realty Income, I definitely will be adding to. Nutrien as well, probably Pfizer. Enbridge, I might nibble. And like I said, Johnson & Johnson, maybe 1 or 2 shares. It won't be a lot. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have some stocks, some companies you'd like me to cover in the Stock Pick of the Day series, go ahead and drop them down below. Let me know what you're investing in for the month of February. How did your first month in January go? If you have any questions for me, drop them down in the comment section and I will get around to them. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and cancer's money. You should never invest any amount or confidence losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel for a financial advisor.